Welcome to Venture Deep Dives. I'm your host, Peter McEwen. Today, I'm highlighting our exploration of decarbonization, presented by Analyst Rachel Ferm. Prior to joining our team, Rachel worked at Israel's first and largest VC fund, where she specialized in impact and sustainability investing. The world is reaching a critical turning point as it begins to experience the wide range of consequences brought about by global warming. Extreme weather events have gone from once-in-a-generation aberrations to regular occurrences. A new generation of innovators and entrepreneurs is taking on the enormous challenge of not only reducing humanity's carbon emissions, but capturing them from the atmosphere. Rachel's deep dive discusses how bold startups are developing technologies humanity will require to confront global warming while creating entirely new markets revolving around decarbonization. Thanks for listening, and please enjoy Rachel's deep dive into decarbonization.
Hi everybody, welcome back to Deep Dives with Alumni Ventures. I'm Rachel Ferm. I am an analyst with the Purple Arch Ventures team, and today I'm going to be talking about decarbonization. So, decarbonization touches almost every aspect of the built environment or the physical world that surrounds us. Chemicals that comprise every item of clothing we're wearing, the furniture we're sitting on, the tools we're using to receive this video, everything. So, this means emissions are externalities of almost everything we do, both online and offline. So while this is daunting, it also means that the players who emerge essential to decarbonization will be embedded in almost every industry we can imagine. This said, there are extremely exciting initiatives happening across the climate tech world, from renewable energies and battery technologies, electrification and mobility, alternative proteins, tons of new categories emerging constantly in which AV is widely involved in. However, as it would be nearly impossible to capture the entire range of sectors related to carbon reduction in this short time, we're going to talk specifically today about the businesses most directly linked to the very element of CO2. With that being said, we're going to focus today on the enterprise software ecosystem surrounding carbon dioxide, key technologies and hardware for removal, storage, and upcycling, and then tailwinds from the Inflation Reduction Act. So Larry Fink, CEO of $8.5 trillion asset manager BlackRock, said, "We focus on sustainability not because we are environmentalists, but because we are capitalists and fiduciaries to our clients." So this leads us to the problem. This quote pretty succinctly captures what is ultimately an extremely simple, but also extraordinarily profound paradigm shift, which is the acceptance and acknowledgement that climate risk is financial risk. This is a new and powerful paradigm. As we can see from supply chain disruptions, real asset destruction, input shortages, massive insurance losses, escalation of geopolitical risks, economic losses linking to climate change are mounting. The correlation between these is becoming increasingly clear. And this is very important to track and better understand because objectively, destructive climate events are occurring with more frequency and severity. So this paradigm shift in the financial system is also intertwined with the significant social and cultural shifts that were ushered in by the digital era that is in many ways defining a new era of consumerism. So this means there's extra pressure on different companies to demonstrate their commitment to responsible decisions and business practices in relation to the climate for both customers and employees. So things are changing, and many believe we are at a powerful inflection point. Another quote from Larry Fink is that, "I believe the decarbonizing of the global economy is going to create the greatest investment opportunity of our lifetime." And BlackRock is putting their money where their mouth is, now planning for 75% of its $8.5 trillion of investments to be tied to issuers with a specific target to cut net greenhouse gases emissions to zero. This belief in the size of this opportunity is also reinforced by market sizing, in which estimates put carbon and emissions tech to reach $905 billion in 2022, growing to $1.4 trillion by 2027. Okay, so we understand the problem, and we'll talk a little bit about the opportunity. So let's lay it out. One, we are in the beginning of one of the biggest transitions in modern finance. And this is because of many of the drivers that we touched on. This mounting evidence, pretty unignorable, that climate risk is financial risk. That the flip side is true. The S&P ESG 500 has been outperforming the S&P 500 by an average of 4 points quarter after quarter since it began tracking. And this related shift in how we think about this, some of the core assumptions of finance. What do we consider risk? How do we define value? Is it in the GMV or the life cycle of a product, the upcyclability built in from day one? How do technologies change the way we build capital to labor functions? And finally, factors like digitization, allowing for tracking and transparency, open and distributed data and development tools. It's allowing for some of these core requirements of capitalism to truly realize, such as symmetry of information in the market, real reduction of barriers to entry. And together, these are really fundamental shifts. And it is the belief of asset managers such as Larry Fink and many others, specifically coming from the financial system world, that the core tenets of modern finance will integrate these factors, creating a massive opportunity for carbon and emission-related enterprise software and technologies. So while this evolution has been visionary for a while, the business case has really changed due to recent regulations, pushing this from a nice to have to a need to have. And emissions components will be embedded in this evolved financial ecosystem. The companies that will define this industry and own the infrastructure rails for next-gen businesses, the S&Ps, the Salesforce, the Shopifys, et cetera, are right now in their infancy, which makes it an extremely exciting time to be in venture capital. These businesses will crop up to serve the new needs, data, and stakeholder relationships arising from these decarbonization efforts. From compliance and reporting to management to marketplaces and secondary marketplaces and new insurance, the opportunities are endless. Capital and talent influx is surging to meet this urgent opportunity. Now let's get into the physical world opportunities, the upcycling and removing of carbon. Again, so much interesting science and hardware, but to scope, we're focusing just on the company's focus on directly getting carbon dioxide out of the air. So at its most simple, when you take carbon out of the air, you can use it or remove it. The first area is what we'll call circular carbon, which is the ability to capture and then upcycle carbon for industrial products and inputs. This it derives from the application of biotech, biochemistry, and nanotechnologies to create new platforms for upcycling into industrial inputs. Generally, these industrial inputs are massive market sizes, making this a really unique opportunity that's captured a lot of attention in the last 2 years in the VC space. This includes capturing carbon from the air, carbon-based products, or carbon-heavy waste, like agricultural waste, and upcycling, like I said, end product, massive industries, primarily focused on creating fuel and chemicals. Next, we have carbon removal, which can be both biological or technical. The leading forms right now are direct air capture and point source capture. Direct air capture uses machines that almost look like giant fans to basically react with and capture CO2 in the atmosphere. Point source actually focuses on adhering technology to the sites of emissions, generally like fossil fuels, to capture emissions. Both options are maturing quickly and are attractive due to the proximity to industry, provided the cost and resource sharing options that allow for the acceleration of commercialization. Again, back to the business case with regulations, we'll get there quickly, but the business case for both of these type of technologies have really crossed the threshold of viability in just the past few months. All carbon capture then requires storage. So part of this ecosystem of carbon removal, when not upcycling, is about long-term storage, which is bioformations deep underground, deep in the ocean, in biochars, trees, soils, cement, etc. Lots of exciting places to grow there. All right, so let's talk about regulatory tailwinds that are changing this business case. So the groundbreaking $369 billion dedicated to climate solutions in the recently approved Inflation Reduction Act had some pretty distinctive impacts on the decarbonization ecosystem. Most importantly, this changed the cost curve for carbon capture and removal technology by both directly subsidizing the CapEx with direct grants and tax credits for specific facility types, removing different amounts of carbon, as well as through changing the payback period and break-even economics through changing the value of the end product or the price in tons per carbon. So for example, They also broaden the spectrum of capture and what is included to qualify for different federal grants and tax credits, and reduce the minimum facility size to qualify for these additional incentives by pretty drastic amounts. For example, the reduction of 100,000 to 1,000 tons of removal capability. Second, we have the investment tax credit expansion. This is somewhere in around 25 to 30% tax credit. And this was a really core tenet of private-public interaction that propelled solar, wind, and different renewable energies to reach the competitive price and scale that they finally have after the past decade. So this extension until 2025 is really important. Uncertainty regarding the durability and consistency of regulation-dependent unit economics has historically deterred some investment. This new extension eliminates that risk and is a long-term solution that allows for CapEx-heavy and more frontier investments. This also allows the investment tax credit, also extends to new categories of climate technologies and allows for different businesses to then follow these scaling pathways established by Climate Tech 1.0, the renewable energy transition. Finally, what's interesting about this space is that this infrastructure, it can also pave the way for different greenhouse gases. For example, there are fees for methane emissions slated to hit in 2026, beginning at a whopping $900 a ton versus the $180 for carbon. So a lot of these enterprise software and management technologies will be transferable, which is exciting. Okay, so let's talk about some key success factors and checkpoints. These are the things that we're looking for that we must believe to be true, and the factors we should monitor for this sector to yield high venture success. So one, that regulatory tailwinds facilitate technology development and customer adoption. Two, that carbon credit and exchange markets are strengthened by close alignment with the existing financial system. Relatedly, that software is built to scale through integrations with established ERP and financial reporting tools. Additionally, we would like to believe that emerging deep tech categories can use the scaling methods set by the first movers in renewable energy, and ultimately that other emissions can follow what is now being established for carbon. We would also want to make sure that product roadmaps are influenced by regulatory timelines of different geographies and sectors. These are nuanced spaces. There's lots of rooms to gain different advantages from a CapEx perspective when executed correctly. And then finally, we would see high levels of value creation for the stakeholders through expansion via vertical SaaS models, data products, or alternate services as these companies start with a wedge and ultimately grow to build this entire new ecosystem. Okay, let's talk about numbers. Over the past 4 years, there was a 4 times increase in companies committed to being carbon neutral. That now comprises over 1 out of 4 of the global Fortune 500. 90% of S&P companies now publish sustainability reports. These are becoming increasingly enforceable beginning in 2024 with the IRA regulations. 22% of global emissions are now covered by regulations versus 5% in 2010. And there was last year 851 billion carbon credits traded on voluntary local markets, which grew 164% just in 2021 alone. And then this percentage of the value per ton of carbon capture is also growing. So we can see on the right here, these changes are reflected in the investment landscape, with 2022 already having an extremely high transaction values despite the general downturn in the market. All right, some of the technical enablers of the space at the highest level, we have 1, advancements in biochemistry, biotechnology, and nanotechnologies, and then this applications to climate tech. 2, we have the maturity of sensor and satellite-based precision climate data that has proliferated over the past decade or so. 3, digitization and connectivity of supply chains and enterprise operations. So the ability to actually track and understand your emissions, utilizing existing digitization and tools. and for the establishment of these ERP systems that offset marketplaces, different regulatory components can then be embedded into. Then finally, we have artificial intelligence and machine learning enabling kind of widespread taxonomization, predictive analytics, different tracking and modeling of a really complex carbon emissions ecosystem. So everything supporting the world of big data and the allowance for us to venture into creating advanced models and algorithms for these spaces. Okay, so let's get into some venture companies of interest. First, we have Persephone. This is a carbon accounting and management platform for enterprises. Persephone is actually a Purple Arch portfolio company and ran through a large syndication. So many of you listening may have heard of it and certainly will in the future as we maintain a close relationship with them. So Persephone generates compliant reporting for major climate frameworks. They grew from 440,000 ARR in 2021 with PAV's first investment to a projected 20 million plus ARR close at the end of this year. Persephone's closest competitor in the space, Watershed, recently raised their Series B at a $1 billion valuation. Next, we have an example of a carbon offset marketplace, and that is Patch. So Patch is a carbon marketplace that operates an offsetting API platform. So Patch helps companies identify carbon removal projects and exchange carbon credits. Patch recently led a Series B with multiple AV kind of bullseye investors, Andreessen Horowitz, B Capital, Coatue, and Valor at a $55 million valuation. Next, we have Solvera. Solvera is a carbon credit rating and discovery solution. So Solvera integrates into reporting frameworks like Persephone and emerging climate-linked insurance products. They also do some of they do facilitate exchanges, but are working a little bit further on the downstream to set the foundation for this ecosystem. The recent Series A, led by Insight, valued Solvera at $123 million. And I think Solvera is a really interesting example of how this space is already maturing quickly enough to have parallel functions as the traditional financial industry. And to add to that, relatedly, Persephone and Solvera both represent examples of early players establishing a single source of truth in this new ecosystem. Next, we have some companies that are interesting in the hardware space. So one, we have Forterra, which has a technology that converts carbon dioxide into cement. This is a kind of a double win situation in terms of receiving benefits of tax incentives because one, they have the carbon reduction, but two, then also supporting cement, which is newly included category as part of the IRA benefits, given cement has something in 7 to 8% of emissions globally. So Forterra has already surpassed price parity of standard cement, showing that for massive industries, these more futuristic, next gen, and emissions considering models can actually be preferable across stakeholder groups. Forterra recently raised their Series B from Khosla. Great comp in this space is Prometheus, which removes carbon from the air and turns it into gasoline and jet fuel. Recently raised their Series B at a whopping $1.5 billion valuation. Two, we have Living Carbon, which is an example of biological-based carbon removal and storage. So this is a biotech company that enhances carbon capture and storage in trees. They raised a seed in 2022 by a fantastic syndicate, including Felicius, Lower Carbon Capital, Prelude, Soma, and Matt Kaspari, who is now an AV employee. Climeworks, which is a carbon removal company, grew between 2020 to 2022 from $350 million to $1.9 billion valuation as they kind of adjusted their model to learn how to commercialize with very high average order value contracts. Finally, we have Remora, which is moving to the point source capture. So this is a point source carbon capture that converts emissions into industrial inputs. So for example, they attach these tanks to the back of massive trucks working with huge agencies. So these customers can then, which are the freight management organizations and asset owners, can then earn credits for captured CO2. So they recently raised a Series A, which included first round capital, Lower Carbon Capital, Union Square Ventures, and Valor. All right, so how can you stay up to date? I think this presentation will go around, so I will not exhaust this list, but a growing list of blogs, books, Twitter accounts, and podcasts to follow. So, in conclusion, why this space is interesting and potentially very profitable. So, next generation businesses can no longer ignore their emissions profile. Competitive standards for company longevity in terms of value and value creation are shifting. And decarbonization is a really daunting challenge, but that's what makes it a stunning opportunity, as the addressable market is nearly every sector of the economy. The industry is also at an inflection point. There's a convergence of emerging technologies and newfound climate data building upon 10 plus years of general digitization in business, combined with an unprecedented scope of recent regulations that can really shift the economics of developing, scaling, and adopting these new technologies. And going back to this idea that the addressable market is nearly every sector of the economy, this translates to a very ripe opportunity for VC, as some of today's startups will define entirely new markets and serve numerous industries and geographies. And that is it on decarbonization today. I think there's a lot of people at this company passionate about this space, and reach out to me, and happy to loop any listeners in to any of our number of in-house passionate researchers and mini experts in this space.